Hello, finance and technical analysis enthusiasts. Welcome. Today, we're going to talk about a topic that you probably encounter every single day when you open your charts. You might have looked at these lines and asked, what exactly are these? Or perhaps you've already placed them at the very heart of your strategy. Our topic today is John Bollinger and his world-famous Bollinger Bands. You've likely all heard this name. The tool he developed is used today by millions of traders, from Tokyo to New York, from crypto markets to commodities. But we are not going to have a shallow conversation like, price touched the top, so sell. Price touched the bottom, so buy. The real issue is this. Bollinger Bands are not just a technical analysis tool. They are a method for measuring the breadth of the market. It is a system that takes the pulse of the market, fitting its fear and greed into a mathematical framework. So, do you think an indicator is just a line, or could there be a much grander philosophy behind it? In this episode, we will look at John Bollinger's life, his approach to the markets, and the invaluable lessons he left us, lessons that are often misunderstood. If you're ready, grab your coffee and let's get started. Let's go back to the beginning of the story, to who John Bollinger is and how this idea sprouted. John was born in America in 1950. When he stepped into the financial world in the 1970s, markets were not like they are today. I want you to imagine this. No smartphones in our pockets, no screens streaming data in milliseconds. We are talking about an era where computers were very limited and charts were drawn by hand with pencil on graph paper. At that time, analysts generally used fixed percentage bands to understand if the price was expensive or cheap. They would simply draw a line 3% above and 3% below the price. But there was a question gnawing at John Bollinger's mind. He said, the market is not a static structure. Sometimes it's very calm, and sometimes it acts like it's gone crazy. So why should the ruler I use be fixed? What he was looking for was a relative measurement. He was searching for the answer to the question, is the price really expensive, or is it normal considering the current madness of the market? While chasing this question, he was also explaining technical analysis on Los Angeles-based television programs. When he used the phrase Bollinger Bands on screen for the first time, many people thought it was just a visual garnish that looked good on TV. However, behind those bands lay a very powerful mathematics that explained market dynamics. Standard deviation. As the founder of Bollinger Capital Management while managing funds and making money for his clients, he also ensured that this new tool became a permanent fixture in financial literature. For him, the market was a living organism, and the bands measured the breathing of this organism. So how exactly were these bands born? Let's get into the technique and history a bit. As I mentioned before Bollinger, names like J.M. Hurst or Mark Chaikin were drawing fixed envelopes around the price. But the problem was this. The market wasn't fixed. Volatility was changing every moment. I'd like to remind you of John Bollinger's famous quote, asking the market what is happening is always better than telling it what to do. With this understanding, he threw the fixed band idea into the trash. The width of the bands had to open and close on their own, according to the market's volatility. Standard deviation is a tool in statistics that measures how far data strays from the average, and Bollinger discovered that this was the perfect fear and greed gauge for the market. Thus, the bands began to speak the market's own language. Now let's look under the hood, at the formula. Don't worry, I won't drown you in math, but understanding the logic is essential for building a strategy. The system consists of 3 lines. The middle band is actually the 20-day simple moving average we all know. The upper band is found by adding 2 standard deviations to this average, and the lower band by subtracting 2 standard deviations. Bollinger says more than 90% of price action takes place within these bands. So, when the price goes outside the band, this is statistically a rare event and is trying to tell us something. However, flexibility is very important here. John Bollinger says these settings are not set in stone. If you are trading short-term, you might use a 10-period average and 1.5 standard deviations. If you are looking long-term, 50 periods and 2.5 standard deviations might work better. In his own words, as the period lengthens, you must increase the standard deviation multiplier. Think of the gold example. On a weekly chart, bands with 50 periods and 2.5 deviations have successfully shown years-long major uptrends by filtering out the noise. In other words, you need to tune the indicator according to the time frame you are looking at. Let's get to the most crucial point. Bollinger Bands are perhaps one of the most misunderstood and misused indicators in financial history. Do you know what 90% of investors do? When the price touches the upper band, they say, "It's risen too much, I must sell immediately." Or when it touches the lower band, they say, "It's got too cheap, I must buy immediately." Friends, John Bollinger never said this. In fact, he described this as the biggest mistake. His emphasis is very clear. Just because it touched the bands is not a signal to open a trade. Confirmation is always required. The bands alone are not a buy or sell signal. They are a framework, a context. To complete the picture, you need momentum and volume indicators. Bollinger particularly recommended indicators like RSI, OBV, and MFI. Why? Because while the price is walking up the upper band, appearing expensive, if the RSI is also strengthening, this is not a selling opportunity. On the contrary, it is the harbinger of a very strong uptrend. But if the price is going to the upper band while the RSI is weakening, that is when you should be afraid. So, looking at the bands and opening a trade immediately is like looking at only half of the photograph. So what are the correct strategies? John Bollinger offers us three main methods, three main roadmaps. Let's detail these. First strategy, volatility breakout, famously known as the squeeze. When you look at the chart, sometimes you see the bands tightening thoroughly, almost becoming like a pipe. This is the moment the market goes quiet. Volatility drops. It is the silence before the storm. Bollinger says the squeeze is the most reliable forecaster of large moves. After the bands tighten, whichever direction the price breaks out aggressively, the trend explodes in that direction. Remember, that massive rally in Bitcoin in 2020 came right after such a historic band squeeze. Second strategy, trend continuation or walking the band. This is the part that breaks the mold. Most people expect a drop when the price sticks to the upper band, but in strong trends, the price sticks to the upper band and uses it like a ladder to keep climbing. John Bollinger calls this walking the band. If there are breakouts outside the band and indicators like RSI support this, do not sell. It means you are in the strongest phase of the trend. Third strategy, W bottoms and M tops. This is a technique combining Arthur Merrill's patterns with the bands. Let's say the price dropped, spilled outside the lower band, and made a low. Then it recovered, dropped again, but this time the drop stayed inside the lower band. This is a perfect W bottom formation, showing that momentum has weakened and the decline is over. It is one of the safest places to buy. Similarly, M formations formed at the top produce sell signals. Of course, Bollinger's toolbox isn't limited to these. We also need to mention slightly more advanced uses, %B and bandwidth. The %B indicator tells us mathematically where the price is within the band. If the value is 1, we are at the upper band. If it is 0, we are at the lower band. Thanks to this simple ratio, we give a mathematical answer, not an emotional one, to the question, is the price cheap or expensive? For example, 1, if the %B value in the EUR/USD pair has dropped to 0.1 levels and the RSI is showing divergence, a reversal is near. Bandwidth is like the heartbeat of volatility. When bandwidth drops to historical lows, know that a big event is approaching. In the early 2000s, bandwidth on the gold chart dropped to historical lows. Nobody was looking at gold. And subsequently, gold tripled in value within 5 years. Those who could hear this silence made a fortune. There is also the use of double Bollinger bands. Imagine adding both 1 standard deviation and 2 standard deviation bands to your chart at the same time. If the price is in the zone between the first and second deviation, this is called the buy zone and the trend is very strong. When it falls into the neutral zone in the middle, the trend has weakened. This method is very popular among Forex traders for trend following. To wrap it up, friends, John Bollinger taught us this. No indicator is a magic wand. Let's remember the 3 big lessons he gave us. 1. Never trust a single indicator. Bollinger bands are a context, but make the decision with confirmation mechanisms. 2. Listen to the rhythm of the market. Volatility, meaning the expansion and contraction of those bands, is the market inhaling and exhaling. If you don't hear that breath, you will drown. And 3. No strategy works without adapting it to your own style. Those who caught the 2020 rally in the Bitcoin chart, those who escaped the crash in the S&P 500 in 2008, were those who read these principles correctly. Instead of panic selling when the price stuck to the lower band, they analyzed whether this was a W bottom opportunity. Instead of short selling immediately when the price touched the upper band, they asked, Is it starting a new rally by walking the band? John Bollinger didn't just leave lines to the financial world. He showed us how to look at the market, how to see the order within the chaotic seeming price movements. Remember, every trader must chart their own path, but having such powerful flashlights in our hands makes our job much easier. I hope this broadcast has somewhat changed and deepened your perspective on Bollinger Bands. Look at your charts with these eyes, and try to hear what the narrowing and widening of those bands are whispering to you. See you in the next episode. May the market be with you, and I wish you profitable trades.